Imagine waking up one ordinary morning and checking your investment account. Yesterday, everything looked perfectly fine and completely normal. Today, the balance is empty. It is not down a little. It is not temporarily volatile. It is not something that will recover next quarter. It is simply gone. Your retirement savings disappear overnight. Your child's college fund evaporates. Your company pension collapses into nothing. Now here's the part that should make you deeply uncomfortable. The company you trusted was not some unknown startup operating from a garage. It was voted America's most innovative company 6 years in a row. Wall Street adored it. Financial analysts praised it. Politicians protected it. Auditors approved it. And yet, beneath all of that prestige, something horrifying was true. The company was selling nothing real. There was no solid product. There were no sustainable profits. There was only smoke. There were mirrors. And there was a carefully engineered $63 billion lie. This was not a market accident. This was not bad luck. This was one of the most sophisticated financial deceptions ever sold to everyday investors. Today, we are going to open it up and examine the body. My name is Dr. Slim, and I spend an unhealthy amount of time studying financial disasters and market failures. If you have ever felt confused, betrayed, or manipulated by the stock market, this breakdown is for you. What we are about to talk about is not just the story of Enron. It is a warning label for modern investing. When most people hear the name Enron, they picture power plants and electricity. They imagine a traditional energy company producing something tangible. That picture is exactly what Enron wanted you to believe. Enron did not primarily make energy. Enron made narratives. Enron sold complexity. It sold stories about explosive growth. It sold stories about innovation. It sold stories about a future so complicated that only Enron executives could supposedly understand it. By the year 2000, Enron's market value reached $63 billion. That made Enron larger than Boeing. That made Enron larger than Disney. That made Enron larger than Lockheed Martin. Those companies build real things. Enron built financial illusions. At its core, Enron was a middleman pretending to be a technology company, and Wall Street rewarded the performance. Let us challenge a dangerous assumption right now. A big name does not mean a safe investment. Fortune magazine named Enron the most innovative company 6 consecutive times, 6 times in a row. That should have triggered skepticism. Instead, it disarmed investors completely. Awards activate a psychological shortcut called authority bias. When powerful institutions approve something, we stop asking questions. We assume someone else already did the hard thinking for us. That single bias erased billions of dollars in skepticism, and it allowed the lie to grow unchecked. The deception became surgical through accounting. Enron relied heavily on a method called mark-to-market accounting. Normally, companies record revenue when cash actually arrives. Enron recorded revenue based on optimistic projections of the future. If Enron signed a 20-year contract, it estimated total profits up front. Then it recorded those estimated profits immediately. No cash needed to arrive, no results needed to materialize, no risk needed to disappear. Now multiply that illusion across thousands of contracts. That's how profits were created out of thin air. On paper, Enron looked unstoppable. In reality, it was unstable by design. Eventually, projections fail. Reality always shows up. When fake profits collided with real losses, Enron did not erase the losses, it relocated them. The company created hundreds of off-balance sheet entities called special purpose entities. These entities existed solely to hide debt. It was financial body dumping. Imagine a doctor discovering a ticking bomb inside a patient. Instead of removing it, the doctor moves it into someone else's body. Then he declares the patient perfectly healthy. That's exactly what Enron did with its debt. The company looked profitable on paper, but internally, it was hemorrhaging. By 2001, Enron reported over $101 billion in revenue. Its actual operating cash flow was barely positive. More than $30 billion in debt sat hidden off the books. This was not innovation. This was a corpse wearing luxury branding. Many people believe they would have seen this coming. That belief is comforting, but it is false. Complexity acted as armor. The financial statements were intentionally unreadable. Analysts nodded rather than admit confusion. Social proof dominated decision-making. Every major bank issued a buy rating. Doubt felt embarrassing. Executive charisma filled the gaps. The CEO sounded brilliant and confident. Confidence often substitutes for competence in financial markets. Fear of missing out controlled behavior. The stock climbed from $7 to $90. Nobody wanted to sell and look foolish. Inside the company, one person tried to stop the disaster. Her name was Sharon Watkins. She warned executives that the company would collapse under accounting scandals. Her warning was precise. Her analysis was accurate. Management ignored her completely. Truth is inconvenient when bonuses depend on silence. In October 2001, the company reported a massive loss. Then another loss followed. Then another. Credit agencies downgraded the company. Liquidity disappeared. Confidence collapsed. By December 2001, the company filed for bankruptcy. $63 billion vanished. Employees lost jobs. Retirement savings were wiped out. Executives walked away with millions. This was not just fraud, it was collective blindness. Cash flow matters more than reported earnings. If a business can't explain how it makes money in one sentence, caution is required. Always watch insider behavior. Executives selling while telling the public to buy is not confidence, it's a siren. Awards often hide reality instead of revealing it. This can happen again. The names will change, the industries will change, the psychology will not. History repeats not because people are stupid. History repeats because people are human. Markets don't fail randomly. They fail predictably when people stop asking uncomfortable questions. This company was not just a business, it was a warning label. Learn from the past, protect your future, and never let another $63 billion lie slip by unnoticed. This was a financial autopsy. I'm Dr. Slim, and I'll see you in the next one.